So the only cover that the banks will have and the Fed will have is if we have a recession / depression by the start of 2024. Now, that will enable the Fed to lower interest rates slowly and with reticence. However, I don't know if that's really good news for the stock market or banks. So what I'm trying to say, there is no easy answer here. There is no pain-free escape.
This is Kaiser Johnson with Liberty and Finance, and this is the Miles Franklin Weekly Special for October 9th through October 16th, 2023, while supplies last. This week we feature two different specials: Silver Morgan Rounds at $2.09 over spot from CNT, and half-ounce Gold Eagles at $1.15 over melt. First, the Morgan Round from CNT celebrates the classic Morgan dollar, but is 4 nines fine and 1 full troy ounce of silver. It's also IRA eligible, and at just $2.09 over spot, a great way to stack 4 nines fine 1 ounce silver at a low premium. Next, the Gold Eagle is one of the most popular gold bullion coins in the world, providing incredible recognizability and investor trust. The half-ounce Eagle adds a further degree of flexibility and liquidity. They come 42 a tube and are available at just $1.15 over melt while supplies last. They're also IRA eligible. And if you'd like to learn more about a precious metals IRA, call us and we'll be happy to help you in that process. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Michael Pento from Pento Portfolio Strategies. Michael, thank you so much for joining us today.
Always good to be on with you, Elijah.
Well, it's great to have you. I did want to discuss the Israel-Hamas war, the unfortunate, extremely tragic events that happened in the last few days here, and it's escalating as we speak. Your perspective on that and also the financial ramifications of this conflict.
You're asking me my perspective on the war in general, or just the economic and market?
The financial aspects, yeah.
Financial aspects. Well, the price of oil was already rolling over because of the coming global economic slowdown, which has been long delayed because of the massive stimulus that was perpetuated on the American people and indeed across the world. But we're eating through that excess savings very rapidly, and those delayed effects of 525 basis points of rate hikes are hitting the economy. Also, you see the bond market, the U.S. bond market fracturing too. I think that's the main thing that I'd like to talk about today. And there are many reasons for that, but we'll go through them. But the fact that we might have Iranian oil off the market, if they are going to somehow, I don't know if this is true or not, but if Hamas was supported by Iran, then we might see Iranian oil exports cut off, and that would support the price of oil. So for my portfolio, generally speaking, when you are entering sector one of that 5-sector spectrum of investing, which is recession and deflation, you wouldn't buy any base metals or energy. You wouldn't own them at all in your portfolio. But I'm actually looking to add some energy into the portfolio as a hedge because of that, fat tail risk of Iranian oil being cut off the market. I'll just make one comment on this massive human tragedy that we see happening what happened with Hamas, which are barbaric terrorists, and then the response from Israel, which is just knocking down buildings in Gaza. It's just a tragedy. It's just you wonder about the evolution of mankind. I think it maybe our compassion stopped with the chimps, if you believe in evolution. It's disgusting to know that human beings could do this to each other. And we pray, and I always pray for peace, because violence begets violence. We know that. So I don't have any answers, but I am in prayer that, and I do say that I did close one of my podcasts with this, that if you love God, if you purport to love God, then you demonstrate that or prove that by your love of people. If you're showing your love for God by murdering people, then it's an apostasy. It's not real.
I think obviously praying and fasting right now is a good thing to do. I know the bishop of the Holy Land, one of the bishops, wrote a letter and called for a day of fasting on Tuesday and prayer. I'll put a link in the description of this video to that letter. It would be a very good letter for everyone who's paying attention to this conflict. I did want to ask you about the bond market. As you mentioned, you said that was a very significant financial aspect of what's going on right now. What are we seeing? Because it seems like we're seeing a major crisis in the 10-year right now.
Yeah, I mean, the bond market is trading like a micro cap penny stock. When you see yields jump 10 basis points every day, up and down on the 10-year, mostly up, and the flattening of the yield curve going from minus 100 basis points to minus 25 basis points a couple of days ago. Now it's minus 45 basis points. So that's how rapidly things are changing. You're seeing just the liquidity in the bond market drying up. And I think by March of 2024, so we're talking about 5 months from now, I think that the amount of liquidity in the bond market is going to completely evaporate. And I make some points about this. So the U.S. national debt is $33.5 trillion. And the interest on that debt is about $712 billion for fiscal 2023. Just the interest on that debt. And when you're adding to the $33.5 trillion, you're adding, this is how I look at debt. I don't look at it as a percentage of GDP. I look at it as a percentage of our federal income. Because you can't tax 100% of GDP. If you tax 100% of GDP, your GDP would be zero. So you look at the revenue. So the nation's annual deficit, you're adding to the amount of debt 45% of your entire income, federal income. 45% of your income. So you have your income from your taxes, federal taxes. 45% of that income is being added to the national debt. Just think about that. And the amount of debt outstanding is 771% of federal income. In other words, if you were a person going to the bank for a loan, and you said that, what's your salary? Well, I make $100,000 a year. Oh, and what are you adding to your debt? Are you paying off your debt? How's it going? I'm adding $45,000 to my debt every year. And the debt outstanding is 771% of my income. The banker would throw you out of they would just throw you out of the bank. You would have no access to credit whatsoever. So, that's the situation that we see now in the bond market. The supply is overwhelming and the buyers are gone. Japan is relaxing yield curve control. That means that their bonds are rising. They used to be around 0%, 10-year JGBs, 0, maybe 10 basis points. Now they're 80 basis points. Japan is also having to unwind its currency reserves, which are treasuries, sell the dollar, buy back the yen to support that, which is a crumbling currency. China is having to sell the yuan, their reserves, to support the yuan by selling treasury, selling the dollar, buying the yuan. The Fed is no longer supporting the bond market. They used to be a big buyer in the bond market. Now they're a seller, $95 billion a month. So the buyers are gone. The buyers have become sellers, and there's this massive overhang of supply. And at the same time, if you want to believe the Atlanta Fed, we have GDP growth for Q3 is 5%, over 5% now. And if you believe the Labor Department, Bureau of Labor Statistics, inflation has gone from disinflation to reflation. We're going higher now, further and further away from the Fed's asinine 2% target. So you look at those 5 factors I just mentioned, the bond market is trading like a micro cap penny stock. And come March of 2024, the reverse repo facility, so think about this. All of the stimulus from COVID ended up in bank deposits. These deposits create reserves, and the reserves excess reserves end up at the Fed because the Fed's paying them interest. There's $2.5 trillion of excess reserves in the reverse repo facility. That's down to $1.2 trillion. In the last 5 months, $1 trillion has gone out of the reverse repo facility, which is reserves out of the banking system, out of the economy, going into the economy. So it's offsetting the QT program completely. Come March, those reserves will be zero. No liquidity in the reverse repo facility. That means every bond that's going to be sold to support our $2 trillion deficit has to go to the public with no help from the banking system, no easy help from the banking system. In other words, no, it's not just like they're taking money from the Fed's one pocket and put it in the Fed in the other pocket. That's gone. So I think the bond market chaos is going to increase big time in March of 2024. And if you think that's going to be good for the stock market, boy, oh boy, it's going to be ugly.
You mentioned how there's really no buyers left of U.S. Treasuries. It seems kind of interesting because interest rates are so high. It's, they're a better deal than they ever have been in the recent history. But why does nobody want to buy U.S. Treasuries right now?
Well, not that no one wanted the Treasuries are being bought, Elijah. They want to get paid. They want to be compensated. I mean, usually if you look at let's just look at the benchmark Treasury. Usually trades about 200 basis points over inflation. Well, if that was the case today, then the Treasury should be yielding 5.7%. It's not, instead of 4.7%. So Treasury buyers need to be compensated for the inflation. Now, if inflation was 2%, then the 10-year note should be 4%, about that. You have to be compensated for going out in duration along the yield curve. So you are finding buyers. They just want to get compensated for that risk. The added risk of inflation, inflation was almost 20% in reality just about a year ago. So it's down now to 3.7%, but that's, still far above the Fed's target and far, far away from stable money. So it's just a matter of being compensated. You'll always find buyers for Treasuries at a price. And the price is much lower than ever before, and the yield is much higher, ever before in recent times.
What are the ramifications of this then for the rest of the financial system? Spiking yields and less demand for U.S. Treasuries at current prices. Well,
I look at a study from Bank of America that showed one third of the companies in the Russell 2000. It's a lot of companies, right? 1/3 of the entire scope of the companies in the Russell 2000 are unprofitable. And they survive by what? By raising debt. So if you're raising debt at 4% a couple of years ago, and now that debt is 9.5%, you've got a big problem. You have an existential crisis. And small businesses are responsible for most of the hiring in this country. So as those companies shed jobs, I would expect the unemployment rate to tick higher. That's going to affect the real estate market. And then you'll see the stock market, real estate market, and bond market in chaos in concert together, concurrently.
It seems like we already have seen a bit of a pullback in the stock market the last 1 to 2 months here. Do you see this as the beginning of another downturn, or what do you make of what's happening right now?
I do, because the stock market is extremely expensive by any metric: price to sales, total market cap to GDP, Shiller Cape ratio. So by any measure, the stock market is way overvalued. And the earnings projection for the growth in 2024 is 12%. 12% earnings growth, Elijah, in an economy that's going to be decelerating rapidly towards recession. And with inflation, you could get there just in nominal terms if inflation was 20%, but inflation is probably going to hover around these low single digits. So there's no way you're going to get 12% earnings growth. It's going to be closer to zero. And the market's price for the soft landing or no landing, which is it just can't happen. I'll tell you, in the same month that the reverse repo facility runs dry, there's currently $100 billion, over $100 billion in distressed bank assets currently festering. I call it festering with the bank term funding program. And what happened was the banks were bankrupt back in March, right? And the reason why they were bankrupt is because deposits were fleeing the system, because banks couldn't raise their deposit rate to match anything close to what the Treasury was paying them. Well, that's gotten worse. That condition has gotten even worse. And those assets that are at the bank term funding program, banks were given par value when these assets were trading at cents on the dollar, pennies on the dollar. Now the Fed is supposedly in March giving these assets back to the banks, and the banks have to return 100 cents on the dollar to the Fed when these assets are worth even less when they were bankrupting the entire regional banking system. Right? Do you follow what I'm saying there?
Yeah, and I think it's really interesting how the crisis has really just been postponed. There's been no real solution for this long term. I mean, the crisis is still on the horizon.
The Fed keeps raising interest rates. They might be done. I think they maybe have one left, but they're probably done. But we're at 5.25% on the Fed funds rate, 5.3 effectively on the effective Fed funds rate. But that's short term. The longer end of the curve is coming up, right? So rates are rising rapidly, even out on long duration. So these assets that were parked at the Fed are further underwater than they were when they first went there. So if Powell gives them back to the banks, these banks are going to be going bankrupt one after the other. So he can't do that. So what he's probably going to end up doing is rolling over these assets, which has inflationary implications. Because in effect, then isn't he then monetizing this debt again? So you either have you're either going to have a recession, depression, and rapid deflation, or you're going to have runaway stagflation like we've never seen before. That's where we're headed. Either one, it's binary because you can't have it both ways. The economy can't exist when real interest rates are positive. There's just too much debt outstanding. Government can't fund itself. Corporations can't survive. The real estate market can't withstand where, the real estate market is higher today than in 2006, the prior apex. And I don't mean just nominal prices. Of course, that's true. But as a percentage of income, the real estate market is out of reach. The real estate market is frozen. So we have dysfunctional markets because they're all artificial. How does that change? You have to let the market function properly. In other words, you have to let asset prices fall, and that's gonna entail a recession or a depression. And then the Fed will cut rates, and then the banks will heal. But you're gonna have to have this cathartic cleansing, purging of asset prices.
Now, the bank term funding program, that's a 12-month program, correct? I mean, it's not like indefinite.
No, that's what I said. March of 20. So March of 23 is when we had those banks. 4 banks went under, and the Fed immediately printed $400 billion in 2 weeks to bail out the banks. And the banks just sent in 2 weeks. They sent the Fed $400 billion in distressed assets. Now, those assets, as I said, right now the BTFP has $100 billion in it. Those assets, a good deal of them are going back to the banks, and at a worse condition than they were when they first got there.
So it seems like, yeah.
Also, I just want to, also, by the way, come March, the lagged effects of those 500 basis points, they usually, when you raise interest rates, it usually has a lag effect of about a year. Some people say a year, some people say 6 months. Let's say a year to year and a half. That's the time frame when those lagged effects really start to bite. So you have that happening at the same time the BTFP program is supposed to, those assets are supposed to go back. All those banks that sent those assets in March, that's when the big spike came into the Fed's balance sheet. You can see that balance sheet spike $400 billion in 2 weeks. Those go back to the banks at a fraction of their value. Banks are already impaired. They're just becoming zombies because they can't make new loans because they know these assets are coming back. So they're very cautious in how they lend. I'm not talking about the big money center banks like JP Morgan. I'm talking about the regional banks in the KRE ETF. And at the same time, the lag effects hit, and the same time that the reverse repo facility runs dry. So I think we're going to have a big problem in the stock market, real estate market, and of course the bond market, which is the linchpin to the whole thing in March of 20, but between now and March of 24.
It is interesting how it seems like we have that definite time frame on it, because that program ends in March of 2024. Do you think they could extend that, or are things getting so bad that really by then things should come down?
No, the only way you can, the only thing you can make the situation with the banks calm down is if the Fed was rapidly cutting interest rates. So right now the problem with the banks is they just can't pay depositors 5.25%, right? They just can't do it because their assets or their loans are yielding yield 3%, 4%. I can't pay a depositor 5.25 when my assets are 4. I mean, it's a prescription for insolvency. So they just say we can't do that, and that's why all the deposits were leaving the banking system and going to J.P. Morgan. That's all. So the way you fix that is you have the Fed lower interest rates, and you have the yields in the money market come down. Treasury yields plunge, and the Fed funds rate plunges. Now the banks have some wiggle room. But how could the Fed possibly do that when inflation is rising from the 2% target towards 4%, double their target? How can they do that? Well, they can't. So the only cover that the banks will have and the Fed will have is if we have a recession / depression by the start of 2024. Now, that will enable the Fed to lower interest rates slowly and with reticence. However, I don't know if that's really good news for the stock market or banks. So what I'm trying to say, there is no easy answer here. There is no pain-free escape.
Now, if there's no pain-free escape, how do our viewers prepare for that, right? What are some maybe recession-proof investments that you're looking at right now?
Well, the swings between inflation and deflation are going to grow more intense over time. And I have a model, 20-point model, very, very robust. So I'm timing my entrance into what I call the economic Armageddon portfolio, or the 4 horsemen of the economic apocalypse, which is, I know there's a little, very little hyperbole there, but it's going to be a really ugly time. There are times like in the year 2000 to 2002 to, from 2000 and middle of 2007 to March of 2009. COVID broke out in early 2020. There was a repo crisis in 19. There are times when you have to, what I call, climb aboard the 4 horsemen of the economic apocalypse. So you need cash, right? You have to hold some cash. Short-term treasuries. You want to go too far out on the treasury. A little bit. You can go a little bit out, but not all the way out on, not going to buy 0 coupon bonds or extended duration bonds. They won't serve you very well. You have to own the US dollar, and you will have to short the stock market. If you do those 4 things alone, and maybe have a little bit of gold, but it has to be physical gold, not the miners. You own those 4 things and maybe a little gold, you probably, in the past, rather than getting hurt, you will make money in the next crisis. And at every crisis, you can backtest those 4 things I just mentioned. Owning the dollar, shorting the stock market, of course, cash, and treasury bonds. Always made you money in the past. No guarantee you're going to do it again, but that raises the odds astronomically that you not only won't get hurt, but you can make money. Now, when you enter that trade, I'm looking at the model to tell me when to enter the trade. So I'm not in that construct when it's not appropriate for me or my clients. So I'm looking at initial jobless claims. I'm looking at financial conditions. I'm looking at credit spreads to get that timing as accurately as possible. We're heading that direction. We're just not there yet. But Elijah, we should be, according to my thinking and the math and the data that I look at, based on that reverse repo facility and the end of the bank term funding program's duration, depending on what Powell does, we very well could be there by March of 2024 and the lagged effects of those rate hikes.
And if our viewers are interested in learning more about your work and following your model, how can they get involved?
So the website is pentoport.com. You can email me at mpento@pentoport.com. If you have $100,000 and you're a U.S. citizen, you could contact us and we'll take care of you in that IDEC portfolio. And if you don't, and if you just want to get my thoughts and the research that I do every week, without me managing your money and get a general idea of where I'm investing in general terms, you can subscribe to the midweek reality check for $50 a year. Fantastic.
Any last thoughts before we let you go, Michael?
Well, I like your question that you started with. We pray for peace, and we show our love for God by the way we treat other people. So let's try it. Let's try that for a change.
Sounds good. Thank you so much, Michael, and God bless.
You too.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we can let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Kaiser, my brother Elijah, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.